Okay, is everyone settled in here? It's time to start, and I usually start in time because I have tons of overheads, and I really like slides because they present a great story about what we think is going on. My name is Steve Hochberg. I'm Chief Market Analyst at Elliott Wave International. Are you familiar with Elliott Waves? Anyone here? Okay. Oh, a lot of people. Okay, that's great. I work with Bob Prechter, who started our company back in the 1970s, president of Elliott Wave International, and I write a monthly newsletter with my partner Peter Kendall called the Elliott Wave Financial Forecast. And of course, Bob writes the Elliott Wave Theorist, which he's been doing since the late 1970s, which is something in itself because usually you don't get that breadth of knowledge and that length of time in the markets, and it's really something to see. And it's great to work with them too. In any event, if you look at the overhead here, you see in that yellow, it says elliottwave.com. If you want to write that down, because that's our website, it's very important. We have a ton of free material on it. We have a lot of articles and a lot of interesting material on what Elliott Waves are and how they work. And I'm going to hit on that a little bit in today's workshop. But if you're interested at all in what I have to say, please go to the website and check us out. So the title is Crisis and Opportunity in 2019, an Elliott Wave View of the Markets. And I want to start by taking us back a year in time. And I want to start at the end of 2017 going into 2018. Because what was going on in 2018? Well, the market in January of 2018, if you remember correctly, was rallying very strongly. And in fact, for the month of January, the stock market got off to its best start in 31 years. And according to the January indicator, if you have an up January, you're supposed to have an up year in the market. So everyone was super bullish at the beginning of the year. This was published by CNBC on January 24th, 2018. So a little over a year ago, a year and a month ago. Well, what was the psychology going on in January of 2018? Well, the market had been rallying so strongly at the end of 2017 into the start of the new year that people had an envy. They were afraid they were going to miss out on the bull market. And if you remember, there was something called FOMO, fear of missing out. Okay, so people were so optimistic on the market that there was a feeling by investors that they had to get in, because if they didn't get in, you just had a great January, you had the great end of 2017, you were going to miss another great year of the bull market. Well, that emotion of envy is something that we recognized at Elliott Wave, and we wrote about in our newsletter, the Elliott Wave Financial Forecast. And if you look in the upper right-hand corner, you see a New York Times headline from a year ago. Everyone is getting hilariously rich, and you're not. And that brought us back directly to the market peak in 2000, remember when the technology bubble was soaring and stocks were going straight up? Well, Newsweek ran a headline that said, everyone is getting rich. Right? So that same emotion presented itself. And if you know anything about what we do at Elliott Wave International, you know we study investor psychology intently because that is the true driver and the engine of what's going on in the markets. So from a great January, how did we wind up the year? Well, the bottom headline was published on December 31st of last year. U.S. stocks post the worst year in a decade as the S&P falls more than 6%. So something was going on, right? Something was happening last year, and we were following it and forecasting that in our newsletter. We went from super optimistic at the start of the year, people were afraid of missing out on what was going on, to a market that wound up the year down, busting that kind of January myth. So what's going on? Well, let's take a look. I think this is what's going on. Okay, this is a picture, a graph of the New York Stock Exchange Composite, one of the broadest measures of what the market is doing. It shows the behavior of over 2,000 stocks that are traded on the New York Stock Exchange. And you can see we had been in a long rising trend from the 2009 low. We all recognize this. This is the end of the great credit crisis and the bear market that lopped over 50% off the Dow and the S&P. And we had been rallying strongly from that low. And we actually started accelerating in late 2017 up to the high, which was here in late January of 2018, which is why people were getting envious. But instead of the market continuing to go higher and higher and higher, something happened. it started what we call this kind of this long topping process throughout the year, this distribution, where one index after another started rolling over. And in fact, by the end of the year, the New York Stock Exchange Composite had broken below this long-term, this multi-year trend line that had contained the rally up until that point. So people were saying, wait a minute, what's going on here? In fact, the decline in December was so strong that people started panicking a little bit. The market was going down very strongly in a very short period of time, and people were wondering, well, what's happening here? Maybe the bull market's still not underway. And in fact, by late December, a lot of news stories were featuring the sentiment of don't panic. Investors were getting so worried, but the media and investment advisors are saying, don't panic. Wealthy investors plan no more money moves. Don't panic. It may actually be a great time to buy stocks. Why investors should not panic. As the market gyrates, don't panic. The top line, wealthy investors plan no money moves, meaning they don't plan to sell their stocks. They believe that the market was going to go up. So we've gone from a sentiment shift of major bullishness in January to a little bit of concern, but investment advisors were telling you in December, don't worry about it. Well, we have a little bit different take on it at Elliott Wave International, and we have a little flippant phrase that we kind of throw out there, which is panic early, avoid the rush. Right? Now, that might seem a little bit fly by night, but what happens is when psychology turns, right, if you're not out in front of it, you're going to get caught up in it. And I want to talk a little bit about psychology right now because it's the most important driver of the market. So what is an Elliott Wave? The Elliott Wave International, well, it was a model, a financial model of the behavior that R.N. Elliott discovered or put together back in the 1930s when he was looking at a lot of different markets, and he noticed similar pattern and similar behavior of investors across all markets, whether it's stocks, bonds, gold, commodities. Any freely traded market typically moves in this pattern that you see right here. And what it is, it's 5 waves in the direction of the one larger trend and 3 waves against it. And if you look at the circled numbers on that chart, 1, 2, 3, 4, 5, leading to the upside, that tells you the trend is in a certain direction, which is up. And then when that trend ends, that 5th wave, you get a 3-wave pullback. Now, there's something very important about this chart I want you to notice, is that an Elliott wave is a hierarchical fractal, simply meaning that it's self-similar patterns at all degrees of scale. So if you look at this large rally right here, you see a 5-wave move in the circles, and if you break down each of those rallies, what do you see? A similar 5-wave rally and a 3-wave movement against the trend. And if you look at even these subwaves here, what do you see? A similar 5-wave move and interrupted by a 3-wave pullback. So it's self-similar patterns at all degrees of trend. And what we do at Elliott Wave International is we try to ascertain where we are within the pattern because it implies something about the future, irregardless of what you read in the news. The psychology, where you are today, implies something about the future. So let's take kind of this model and apply it to the New York Stock Exchange Composite, which I just showed you. And you can see that from that 2009 low, where we have the 4 circled, we have a pretty clear 5-wave rally, that pattern that we saw. Now, what happens at the end of a 5-wave rally when it's complete? You go into a 3-wave correction, right? And that 3-wave correction and the depth of it depends on what degree of trend, what rally you're starting. For example, or what rally you're ending. If you're ending a rally, say, on a weekly basis, that 3-wave decline may last a week at most, maybe just several days. But if you're completing a rally on a monthly basis, that 3-wave decline is going to carry deeper, and it's going to retrace much more and last maybe several weeks to several months. And if you're completing a 5-wave rally on a yearly basis, well, that decline is going to be even bigger. And if you're completing a 5-wave decline on a quarterly or a longer-term basis, it's going to be even a bigger decline. So that's what we're kind of looking at right now, ascertaining what degree of 5-wave rally have we completed. But clearly, something has changed in this market because we've broken the trend line, We've completed the structure, and now we've turned to the downside. And it's just not the New York Stock Exchange Composite you can see this pattern in. This is the NASDAQ, again, from the same 2009 low. The difference in the NASDAQ is it traced out or formed a channel all the way up. And Elliott waves typically form channels. A five-wave move will end its final structure either meeting the top line of the channel or what we call a throwover, bursting briefly above it and then coming back below it, indicating that that trend is over. So we see a completed five-wave rally in the NASDAQ, and we see it in a breadth of market indexes. For example, this is the small cap sector. Again, from the 2009 low, we see that same pattern, that five-wave advance that ended when it met the top line of its channel. And it's not just interesting in the US markets, but if you look at world indexes, for example, this is the MSCI World Index that looks at a whole host of European and Asian stocks also, as well as US stocks. And what's so interesting is, guess what? We saw that same five-wave pattern. We came up, we met the top trend line, this parallel trend line, and then we came down and met the bottom trend line and have bounced off that trend line. All right, so what this is telling us is we've got a complete structure, we're rolling to the downside, and we think, in our opinion, is that we've started a bear market. Now, how long has this bear market been in force so far? Well, the New York Stock Exchange Composite topped in January of last year, so it's 11 months long right now. The mid caps and the small caps held up until August, as did the value line in the NASDAQ. Transportations and the S&P indexes topped in September, and the last index to top out was the Dow. Why? Because it's a blue chip index. People kind of gravitate out of the higher beta, more risky indexes such as the NASDAQ and so forth, and into the last bastion of blue chipness, which is the Dow Industrials. And what's so interesting that we found is that we looked at when different indexes and asset classes peaked out during this great topping process. The process has been underway for almost 20 years now, which is absolutely incredible. But we found that there's a simple way to ascertain how far down you're going, is that usually the longer the top and the longer the topping process, the bigger the decline. And this topping process literally has been historic. A lot of people don't know this, but if you look in the upper left-hand side in that red, this is the Euro Stoxx 50 index. Some of you may not know this index, but it's comprised of the 50 biggest blue chip stocks in Europe. And what's fascinating is that actually peaked in 2000, right? We're now in 2019. 19 years ago, it made a high. It made a lower high in 2007 when the US market peaked in October, and that's been down ever since then. Well, the Dow, denominated in real money in terms of gold, peaked out then too. And as we went forward, each of these indexes topped out. Now, some of them recovered and went to a new high. For example, the NASDAQ, which made a high in 2000, you know, with the tech mania, and then it crashed 78% into 2002. It rallied back to a new high, but since then has rolled over. And what we did was we blew up the last portion of this rally in that inset box that we see in blue to show since earlier last year when each of the sub-indexes, so to speak, that we're watching topped out too. So the longer the top, the bigger the decline. And this top has been historic, stretching out over many, many years. What's also interesting is that it's not just the US. I showed you the Euro stocks, but for example, the Shanghai Composite, which is China, which is a good representation of the Asian tigers, interestingly peaked out in 2007. Okay? 2000. So that's 11 years ago since the Shanghai Composite made a new all-time high. And in fact, in between, it's made a lower high, as you can see in the middle. And we put on some of the comments that we've made in our newsletter concerning China as we go forward. And as it traced out its bear market, it's down still a whopping 57% from its high in 2007. Okay? And China, a lot of people say, well, China is the future, much like they said Japan was the future back in 1989. In 1990, I went to graduate school, and I was up in Boston, and most of my classmates in graduate school were Japanese. Why? Because Japan had been in a huge bull market that peaked out on the final day of 1989, 1990, and a lot of the business schools wanted Japanese students because they thought Japan was the future. Well, of course, Japan went into a interminably long bear market. It still has not made a new all-time high. But what's everyone talking about now? Well, they're talking about China. China is the wave of the future. China is going to lead the world. China is going to overtake the U.S. A lot of people haven't realized this, but China's been in a really nasty bear market since 2007. In our estimation, it's not over yet, and I wouldn't be surprised to see the Shanghai Composite at some point in 2019 below 2,000 on its way down to make its final low in the bear market, but it's not quite done yet. So we've got a world that's kind of rolling over. Usually, Europe rolled over in 2000, Asia rolled over in 2007. The U.S., the blue chip index and the blue chip economy has been the last to hold up. But even now, the U.S. is rolling over. We call this the weight of the world, and we've run this in our newsletter. It was just showing kind of the behavior of the market from 2018 to the present. On top, you see the Dow Jones Industrial Average. In the second graph, this is the global Dow. What it is 150 blue chip stocks that include the Dow Industrials, but also include 100 blue chip stocks in Europe and Asia. So it gives you a broader perspective of what the world market is doing. The third graph down is the MSCI World Stock Index excluding the U.S. So in this index, they took all U.S. stocks out. And then the bottom line is just the emerging market index. Okay, so the Dow declined 19% from its October 3rd high of last year, which was this high, and now it's rallied back. Okay, it's retraced about 70% of that decline. The global Dow declined 21% from a high in January of last year, of 2018. It's retraced about half of that decline right now. The World Stock Index is down a little over 20%. It's had a lesser retracement, and of course, emerging markets have down big. So this is kind of what the market is doing right now. Now, I want to focus in on this right here, this decline right about here, okay? Because this was in November of December of last year. Now, if you remember, the market ended very weak. Everyone thought we were going to have that Santa Claus rally, and never materialized. Instead, the market was plunging toward the end of the year. The decline was so steep, and it scared enough people that it got the notice of who? The U.S. Federal Reserve, the Fed. Okay? And the Fed decided in this year that they're not going to raise interest rates anymore. And people, investors and pundits alike, hailed that as a seminal event, that the Fed was going to stop the decline and save the market. And when they decided not to hike their rate in January 30th, and have a more accommodative stance, people hailed that, investors hailed that as a major bullish event. And in fact, these are the headlines from that day and the next day. Fed's dovish message douses rate hikes, boost odds on a cut. Fed sees low rates well into the future, and that excites Wall Street. Dow surges more than 400 points to above 25,000 as Fed signals patience with rate hike. All right? Fed pivots from hawkish to dovish. Hawkish meaning they're raising rates, to dovish meaning that they're not raising rates and they're going to start cutting rates. And it was universally hailed. And in fact, people loved it so much that this article was written earlier this week, and I took it off of Bloomberg. Greed is back as debt markets face an $8.6 trillion hangover. Prayers have been answered. Okay? It's not only that the Fed is coming to save the day, but hallelujah. All right? The idea that a dovish monetary offset to redress market and growth fears will boost risk assets. And in fact, over the past week, Ecuador, which is a basket case, managed to sell $1 billion in new bonds. Greece, of course you know, which is bankrupt, received blockbuster orders for its 2.5 billion euro sale. And Uzbekistan, encouraged by risk-on markets, is meeting investors for a debut international offering. People are so certain that the Fed is going to save this market that they're rushing to buy the riskiest assets they can. In fact, this is the global value of bonds that are outstanding with below zero yields. Okay, there's 8.6 trillion, meaning that if you bought these bonds and held them to maturity, you would be guaranteed a loss. Now, who would buy these bonds? But yet there's $8.6 trillion outstanding. So, of course, at Elliott Wave, we look at something and we said, let's ask ourselves, is a friendly and accommodative Fed bullish for the stock market? Will the fact that the Fed has stopped raising rates and are now have the prospect of cutting rates, is that a bullish development? So we actually looked at the Fed behavior relative to the stock market, which very few people do. And this is what we came up with, okay? From 2000 to 2003, this period to the left, the Fed cut interest rates 13 times, 13 consecutive times. But the Dow and the S&P still declined over that period. The S&P was down 51% from 2000 to 2002. Well, how about the 2007 to 2009 episode? The Fed, US Fed, cut interest rates 10 times over that period, but the S&P still declined 58%. So is an accommodative Fed and a Fed that's going to cut interest rates bullish for the market? Well, we have recent history to show us one possible answer. Now, we looked at it and we thought, maybe there's something different about this time. You know, maybe it had something to do with inflation. This is the Fed's way of measuring inflation. This is a U.S. Personal Consumption Expenditure Indicator, and we've shown this in our newsletter too. Despite historic monetary and fiscal stimulus, inflation is still running a little bit below the Fed's stated target and their goal of 2%. So we said, well, it doesn't look like inflation has anything to do with it. And in fact, we actually went back and looked at another period of very low inflation that actually led to deflation to see whether maybe the Fed was able to stop a market decline in that period. This is the Dow Jones Industrial Average from 1929 to 1934. And we put on all the times the Fed was accommodative in cutting interest rates during, of course, an historic bear market. As you can see, they cut it 1%, a full point after the 1929 high. They cut it multiple times, a half a point. Market still went down, down, down. For some inexplicable reason, they hiked it a percentage point in 1931. That had no effect either way, and the market continued to go decline. And in fact, from 1929 to July 1932, the Dow Jones Industrial lost 89% of its value. So it's clear that an accommodative Fed is not necessarily bullish for the stock market. And then we ask ourselves, well, if an accommodative Fed is not bullish for the market, how about is a non-accommodative Fed bearish? In other words, is the Fed hiking interest rates going to send stocks to the downside? Well, from 2015, when the Fed started on its latest interest rate hike scenario or cycle, so to speak, it hiked interest rates 9 times from 2015 through the first part of this year. And from the February 2016 low to the high, the S&P still rallied 57%. So then we went back and we looked at the headline and we asked ourselves, is this true? Is the Fed's dovish message an accommodative stance bullish for the market? And the answer clearly is no. As we saw from 2000 to 2002, 2007 to 2009, 1929 and 1932, nor is the fact that the Fed is hiking rates bearish. In fact, the only conclusion you can draw from the evidence is the Fed has no effect on the market. It doesn't matter what the Fed's doing. Why? Because the Fed's simply reacting to what the market is saying. The Fed is not proactive, the Fed is reactive. And whatever the psychology is at the moment, the Fed is being accommodative to that psychology. But it's not controlling the markets. And in fact, the one thing that does signal what's going on is this concept that Bob has written about in his newsletter, and that is psychology. Extreme opinions shared widely constitute the single most reliable indicator of an impending change of direction for a market. And if there's one concept you take away through this whole conference, this is it right here. This is the key, the most important point I can ever make in any of my presentations or what we do at Elliott Wave International. We're looking at extreme opinions that are shared widely because they signal that everyone is thinking one way and presumably they've acted on it, so whatever market you're looking at is ready to move in the opposite direction. Right? So have we seen extreme opinions in the market? Well, we would argue, yes, there's a lot of extreme opinions. And I'm just going to show you a few of them because over the last year, from late 2017 through 2018, we published 35 different indicators that had moved to either an all-time record or a multi-decade extreme. Okay? Here's one of them right here. This is a percentage, a Gallup poll that I've inverted. So as it goes down, the percentage is getting higher, and as it goes up, the percentage is getting lower. And Gallup asked their people that they polled, shows the percentage of Americans mentioning economic issues as the nation's most important problem. Okay? As you can see, a very low 13% thought the economy or economic issues was a problem in 2000. Why was that? Well, because we were in the dot-com mania. The stock market was roaring, and a lot of people at that point in time had their money invested in all these startups and all these dot-com manic stocks, and they thought, well, you know, we don't need to worry about the economy. The market's going up. Well, of course, that coincided with a peak in the bubble, in the mania bubble for dot-com, and they crashed after that. And when they took that poll again in 2002, it went from 13% to 52%. 52% of respondents were worried. Well, what happened from 2003 to 2006 and 2007? Well, we had the real estate mania and the real estate bubble, and the stock market was going up. And they polled them again in the mid-2000s. They asked them, do you think the economy is a problem? And only 16% thought the economy was an economic issue to worry about. Well, what happened after 2006 and 2007? Real estate topped. It crashed, people went bankrupt, and in 2009, 86% of respondents thought that the economy was something to worry about, all right? That was an extreme opinion right here. What has happened since that low in 2009? Well, the market has roared back. We've done this Elliott Wave, this 5-wave rally. And last year, Gallup asked these same respondents, do you think the economy is something to worry about? And a record low 12% said so. All right? So again, this is an extreme opinion, and we think it's coinciding with a peak in just about everything right now. It was the real estate peak and the credit crisis in 2007, 2005 to 7. It was a dot-com mania in 2000, and now we think it's actually the market itself and government. So there's one extreme. Here's another extreme that we published in our newsletter. What this shows is the share of companies completing IPOs, initial public offerings, with negative earnings. They've never earned a penny, yet they're able to bring their shares to market. Okay? A record 83% last year, through that period, of the IPOs did not earn, the companies did not earn 1 penny. And that eclipsed the 81% in 2000 with the dot-com mania. So again, we're seeing an extreme opinion. Here's another extreme. This is the percentage of CEOs that are buying back the shares of their company. Okay? What we found when we plotted this was that they tended to buy back a lot of the shares at market peaks. And you can see the peak in 2000, which doesn't seem like much, but at the time this was a record. And of course, we had the big bear market thereafter. Here, they spiked to a record amount at the time of buying back their corporate shares because they thought it was such a great value. And that was just as the market was peaking and going into the greatest bear market since the 1930s. And we're now back at a record all-time high of CEOs that are buying shares of their company. So again, this is in another extreme. Looking for extreme opinions, this tells us, and this usually occurs at the end of a trend. And of course, mom and pop are completely invested in the market. This is the bottom is inverted scale again, but it shows, because I want to line up with prices, it shows the amount of cash that Charles Schwab's clients have right now relative to stocks and bonds in their portfolio. Here, they had almost 25% of their portfolio in cash relative to assets. in late 2008, 2009. Why? Because we had just gone through a huge bear market where the S&P lost over 50% of the value. They were scared. Well, flip it around. We've just now had a rally since 2009 and almost a record low. Last year was the record, but it's come off just a little bit. Of their amount of their dollars invested were in cash relative to assets. So here's another extreme that we're watching. So when we add this all together and we apply the model that we follow, the Elliott Wave model, we see a completed pattern, we see an extreme in psychology, we see a belief in the Fed that has no basis in fact, and in our view, we're completing this 5-wave rally pattern, not only from the 2009 low, but if you go back, you can say that the 5-wave rally is ending from the 1974 low, and here we went all the way back to that 1932 low, and as you can see, that Elliott wave is traced out to the upside. So as we go into this bear market, it has the potential to be a historic decline as we correct this 5-wave move. Now I want to turn our attention away from stocks. Our view is pretty clear on stocks. So that as we started a bear market in January of last year, it's taken all of 2018 to roll over. The rally that we've had at the start of this year is what we consider a bear market bounce. We think it's just about at its end if it's not over this week. Maybe it has a few more little small subdivisions, and we roll over to the downside from here. What other asset might we look at? Well, coming to this show over the years, it's always interesting to look at the booths because I can always tell what's on investors' minds. A couple of years ago, all the booths over there had to do with pot stocks. Everyone was interested in pot stocks. And before that, it was gold. I want to go over gold because gold traces out clear Elliott waves. And when you know where you are within the pattern, you have a lot of confidence of what's going forward. And this is a market that we've had a lot of success in forecasting. And again, I want to come back to this concept of extreme opinions. And I'm going to show you a lot of extreme opinions with respect to gold. All of them occurred in the rally from 2001 up to 2011. Gold peaked at 1921.50 on September 6, 2011. And as that rally was underway, look at the opinions that were registered as we were in the latter stages of it. Central banks were pouring money into gold. People thought that was the most bullish thing you could do. 98% bullish DSI. DSI is just a firm that polls investors on a daily basis, and they just find out whether you're bullish or bearish on an asset. Well, the scale is from 0 to 100. So when 98% are bullish on an asset, that means there's only 2% bears. That means virtually every single person thinks that asset's going higher. But one of the keys that we talked about, which I thought was perfect, was that, remember that Gallup poll I just showed that people thought there's not really any economic issues to worry about, and that tended to coincide with market peaks? Well, Gallup did another poll right at the high. It was in August of 2011, literally a week before the peak in gold, and the investors ranked gold as their best long-term investment. Now, why was that? Well, because gold had been rallying for years before that. So as the market goes up, people are getting more bullish, and that coincided literally with the top in gold. And as you can see what happened after this huge optimism, gold declined 46% to a low, an interim low at 1046 in December of 2015. And it's been rallying back and forth ever since then. Well, we noticed something back last summer in August that really caught our eye. Gold had been going down for several months, and we started seeing these headlines in mid-August. Gold may fall by a third. Gold rout fuels precious metal carnage. Usually when you get rout and carnage in the same headline, you know you're at an extreme. Gold investors give up hope, right? And so we looked at that and we said, that's a psychological extreme, right? So we actually wrote about this in our letter, okay? And gold went from 91% bulls, that was almost virtually unanimous. People thought it was going to rally back in 2017, and it had been declining to the point where only 6% of the people thought gold would rally further. 94% were bearish. This was in August of 2018 when we saw the headlines. Something else was occurring too. That was silver, which had rallied from 2016, was a very weak rally. It diverged from gold, And silver was making a lower low that was not confirmed by gold. This is a non-confirmation between the two metals. This is what it looked like at the time. Okay, we had that low in 2018 where everyone was super bearish. We thought it was going to rally, and gold actually did rally over 7% to a high and then started backing off. Well, silver came down and made a low, and pessimism was extreme. It got so extreme that a rare occurrence happened at Elliott Wave International, and that is Bob Prechter and Pete and I put out a combined interim report because we looked at the sentiment, we looked at the non-confirmation, we said, you know what? Reversals are likely occurring right now in the US dollar, gold, and silver. Okay? So at this point right here, in November is when silver made a new low unconfirmed by gold. November 14th is when we put out that interim report, and this is what happened the day of the low. Silver rallied 17%, gold rallied 14%. This is a chart that's updated through this week, and sentiment went from single digits on silver all the way up to 61%. Right? So now the question is, what's going to happen with gold and silver going forward? Well, the pattern in gold we've been following has been pretty clear. We peaked out in 2011 in September. We've had the first wave down, this 5-wave decline of a bear market. We call this wave A of an ABC decline. And since late 2015, we've been rallying in an inter-bear market rally. Okay? So this rally here is what we call a B wave that, when it's complete, will lead to another leg to the downside. It's been a complex correction, but we've done a pretty good job staying out in front of it and talking about it in a newsletter. We've been rallying since that low when we put out our interim bulletin. I think gold is approaching a little short-term high. It's probably got a little bit more to go. Maybe it takes another month or two before we put that little high in, but we're going to put an interim high in, and then we'll probably pull back for several months and then rally to the final bear market high. So there's a lot of opportunity over on the short term on gold. Now I want to kind of put that in perspective, okay? Because I showed that pattern, that Elliott Wave model before applied to stocks. Well, this is that Elliott Wave model applied to gold. On the right is that schematic that I showed you, that 5-wave rally. And on the left is that 5-wave rally and how it traced out in the gold market. 5 waves up to 2011. We had an A wave down. We're within the B wave right now. And when that B wave is complete, you're going to go down in wave C. I've drawn a little arrow on where we are. You are here, okay? So I think gold's going to probably trend sideways for a lot of 2019, then finally have a burst up. People are going to call it a breakout. It's going to get above 1,400, and people are going to go, oh my God, gold's breaking out. Gold's going to go to 2,000. Gold's going to go to 3,000. Well, in our view, no. It's a bear market rally. Probably get around 1450 to 1550. We'll have to see what the pattern looks like as we get up there. But when this B wave ends right here, guess what's next? It's the C wave, which is going to take gold well below its A wave low, well below $1,000 an ounce, finally getting us down to where we can count an ABC decline. Right? So if you follow our newsletter, we'll try to keep you ahead of what the swings are in gold. I want to turn to one more market while we have time here, and that is the US dollar, okay, because currencies are important. And the US dollar, as every currency is a fiat currency. It's not anchored at anything. It's just simply quoted in yen or quoted in euros or quoted in British pounds. Right? So it lends itself to psychology extremely well. So this is the dollar from 2001 all the way through late 2007. And the dollar had been declining precipitously. It had been declining over 5 years. It was down over 30%. And people were starting to get very bearish. And I was reading a Bloomberg story, I remember back in late 2007. And it struck me. And the reason it struck me is because I pulled up the story and it said, supermodel Bündchen joins hedge funds in dumping dollars. Okay? This was from November 5th, 2007. Gisele Bündchen, supermodel, aka Mrs. Tom Brady, wants to remain the world's richest model and is insisting that she be paid in almost any currency but the US dollar. And we would submit to you that when a model is so cognizant of a trend that they comment on it, that trend is near maturity and ready to reverse, okay? So we looked at that and we said, it looks like the dollar is coming into a low. And a matter of fact is when we looked at the dollar, this is when Giselle made her statement, which was right here. The dollar went down for basically another month and a half. It bottomed in early 2008 and started a multi-year rally, okay? And that rally has been playing out right now. This is through late 2016, early 2017. We noticed something else. Number one, we noticed it had traced out a 5-wave rally from this low. We know once 5 waves are over, the market corrects. And we also noticed something. There was a magazine cover, and it was in The Economist, and it said the mighty dollar, and it showed George Washington. Look at them all bulked up. Okay, people were super bullish the dollar in early 2017. Why? Well, because it had been rallying for 7 years, or for 5 years, basically, from that low right there. Again, extreme psychology, extreme opinions shared widely constitute the single most reliable indicator of a pending trend change or trend reversal. We thought the dollar was topping there, and we published this chart, last call for the dollar. Okay, well that cover came out right here, right at that high. The dollar declined through all of 2017 and early 2018. In fact, it traced out 5 waves to the downside. And in fact, back in early 2018, the bulls went from 91% to just 8%. All right? So virtually no one was bullish to the dollar as the calendar was turning from 2017 to 2018. We thought that was the end of the decline. This is from February of last year we published this. And the dollar started to rally thereafter. And we were trying to count 5 waves to the upside because we figured once we counted 5 waves to the upside or some variation, the pattern would be over. And in fact, this was part of the interim bulletin that we put out in November. Not only did we have a 5-wave rally, but we had another pullback and a higher high. We called that an ABC. And optimism, as measured by the 15-day daily sentiment index, was back at the peak, which is why we put out the interim reversals likely occurring in the US dollar, gold, and silver. This is the dollar that's updated through the end of last week. So we pulled back. The DSI has come back a bit, and we've since rallied a little bit in the dollar. We're right up and about here right now. Okay? We think this is an ABC rally and that the dollar is ready to roll back to the downside. It appears to us that the euro may make a lower low. The euro may take out its equivalent high here, but I think based on where sentiment is that that's going to be the end of the euro decline and the US dollar will end an ABC rally. So if I have to sum up what we're looking for in some of the key markets, number one, I think stocks started a bear market at the beginning of last year when the broad New York Stock Exchange composite rolled to the downside. That bear market is just starting in our opinion. All right? So while people may be looking to buy stocks, we're looking for rallies not to buy stocks, but to lighten up your portfolio and get into safe assets. Number two, I think gold's in an inter-bear market rally. A bear market rally started in December of 2015. It's not over yet. Gold's probably going to go higher, but it's going to be a kind of back and forth movement through many months this year before it bursts up into the 1450 to 1550 range. And if you follow us in the newsletter, we'll try to pinpoint the exact high because when it makes that high, it's going to be the start of another leg down in the bear market that will wipe out a lot of gold's value. Right? And number three, the US dollar looks like it's going to have problems here and it's going to head to the downside. And the dollar is something we're following very closely now because there's ways the pattern can develop in the future, but that's something we'll definitely be forecasting. Now, what do you do with your money in this environment? Well, you don't want to be heavily invested in stocks. You don't want to, gold's more of a trading vehicle. You can look at bonds, but bonds are in a bear market too. They topped out in July of 2016. So you want to get very short term, we think. This is a concept that Bob presented in one of his Elliott Wave theorists last year. And these are called floating rate notes. And this is specifically a 2-year floating rate note. If you're interested at all, you can go to www.treasurydirect.gov. You buy it directly through them. Now, we're not making a recommendation of purchase because everyone's situation is different, but we are making a recommendation you read up on this. Find out whether this might be right for you. The interest rate is pegged to a 13-week T-bill and adjusts quarterly to the auction rate. Okay? It's not going to give you a huge amount of return, but it's going to give you a return. And our contention is that in a bear market, a long-term bear market, you want a return of your money, not so much a return on your money. And this will give you safety. A lot of banks are going to be in trouble because they're up to their nose in debt. And this is a direct purchase of the Treasury, of the U.S. Treasury. And if interest rates do go up, the interest rate will adjust with you. At some point, you're not going to want to own a lot of these, but this is something you might want to look to park your money in as a safety measure. And that's the number one thing that we're going to recommend to all of our readers, which is safety first. Safety first. Seek safety. In a bear market environment where a lot of assets are going to be deflating, you want to be as safe as possible so you have money to step in when the market actually does reach a low, which is going to be years down the road. So in any event, if you're interested in all what I had to say here, this is where you need to go, elliottwave.com. This is our website, and you can learn all about Elliott Waves. You can learn, they have new articles every single day up there. You can read a lot about what Bob's writing about, and maybe purchase some of his books to see what this kind of concept of the Elliott Wave is, and social mood, and his theory of socioeconomics, which is fascinating. So in any event, I thank you very much. Thanks for coming out, and I'll see you next year.